The purpose of financial analysis is to formulate a diagnosis of a company's financial situation. That is, to make a judgment about its current and future performance and its ability to sustainably finance its operation. It relies mainly on the company's financial statements, income statements, balance sheets, and notes to the accounts. There is no universal methodology for conducting a financial analysis, and in fact, French practice is quite noticeably different from what can be found, for example, in the Anglo-Saxon world, not to mention differences in accounting standards. Nevertheless, there are common features across all approaches. The main stages of a financial analysis should include an analysis of the company's activity, its revenue, its margins, its profitability, its liquidity, and finally, its solvency. It should also be set over time and include a historical analysis covering the past 2 or 3 years, in order to understand the current trends. While accounting documents are the main source of information, a thorough financial analysis cannot do without additional information, both quantitative and qualitative. The company's financial situation must be understood within its competitive environment and in relation to its strategy. That is why sector analyses are necessary to understand the challenges a company faces, as well as how it addresses them and positions itself within its industry. Financial analysis relies on sets of indicators and ratios, some of which cannot be properly assessed unless they are compared to those of competitors. Moreover, the way financial analysis is used also depends on the nature of its users. There are many of them, and they do not all pursue the same objective. A bank will want to verify that its client will indeed be able to repay its debts and pay the interest. A works council will want to ensure the company's economic development. And this will feed into social dialogue, particularly in the context of wage negotiations. One of the main limitations of financial analysis lies in its purpose. That is, beyond diagnosis, its ability to propose solutions to address the problems identified. Yet most of the difficulties observed are not financial in nature. For example, poor inventory management. And therefore, there is no purely financial remedy. This is where, ultimately, does the true art of financial analysis lie?